What if I told you that a kid who started with a single pinball machine would become the world's most successful investor, worth over $100 billion? Even more incredible, he did it without inventing anything, launching a tech startup, or getting lucky with crypto. Today, I'm going to show you exactly how Warren Buffett did it and give you 5 actionable insights that could transform your own approach to building wealth. These aren't just theoretical tips. They're the same principles that turned a paperboy from Omaha into one of the richest people on earth. While other kids were spending their pocket money on candy, young Warren was already thinking differently. He wasn't just running a lemonade stand, he was purchasing 6-packs of Coca-Cola and reselling them for a profit, meticulously tracking every penny. "I always knew I was going to be rich," he once said. "I don't think I ever doubted it for a minute." His first venture into business ownership? A pinball machine strategically placed in a local barbershop. As quarters flowed in, he expanded to multiple locations, eventually selling the enterprise for a handsome profit. By high school, this teenage entrepreneur had already invested in a 40-acre farm. "The best investment you can make is in yourself," Buffett often says. "The more you learn, the more you earn." Inspired by the book, 1,000 Ways to Make $1,000, he became fascinated with the mechanics of wealth building. His father's introduction to the New York Stock Exchange sparked a lifelong passion, as young Warren spent countless hours at local brokerages, studying stock movements and business patterns. Under the mentorship of Benjamin Graham, Buffett learned the principles of value investing that would shape his career. Seek undervalued companies, invest in them, and hold for the long term. But it was his partnership with Charlie Munger that truly revolutionized his approach, shifting from merely buying cheap stocks to acquiring wonderful companies at fair prices. As Buffett puts it, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Let's dive into some of Buffett's most brilliant investment moves that showcase his genius. One of his earliest and most successful investments began in 1951 when he took a train to Geico's headquarters on a Saturday, hoping to learn about the insurance industry. Finding the building closed, he knocked until a janitor let him in, where he met Lorimer Davidson, a financial officer who spent hours explaining the business. Buffett was sold on Geico's efficient direct-to-consumer model, which cut out expensive insurance agents. He invested heavily, and today, Geico is wholly owned by Berkshire Hathaway, providing consistent profits year after year. When the salad oil scandal hit American Express in 1964, causing its stock to plummet nearly 50%, most investors ran for the hills. Buffett did the opposite. He investigated and found that while Amex had been deceived in a massive fraud scheme, its core business, credit cards and traveler's checks, remained incredibly strong. He invested $13 million, nearly 40% of his partnership's assets at the time. Within 2 years, the investment had more than doubled, and American Express remains a cornerstone of Berkshire's portfolio today. During the Watergate crisis, when media companies faced intense scrutiny, Buffett purchased a significant stake in the Washington Post Company for $10.6 million. His analysis showed that the company's assets were worth at least $400 million. By 2014, his investment had grown to be worth over $1 billion, demonstrating his ability to spot value in times of crisis. Perhaps one of his most famous investments came in 1988 with Coca-Cola. Following the 1987 market crash, Buffett recognized the company's incredible brand value and global distribution network. His $1.3 billion investment has grown to over $25 billion, with Berkshire now owning about 9% of the company. The best part? The annual dividend payments now exceed his original investment. In a departure from his traditional aversion to tech stocks, Buffett began buying Apple shares in 2016, seeing it as a consumer products company with incredible brand loyalty. This investment shows his ability to adapt while sticking to his core principles. Today, Apple is Berkshire's largest holding, worth over $100 billion, proving that even in his 80s, Buffett could spot extraordinary opportunities. So what can we learn from Warren Buffett's remarkable journey? Here are 5 key lessons that anyone can apply to their own investment strategy. First, invest with a business owner's mindset. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes, Buffett insists. He doesn't see stocks as pieces of paper to trade. He sees them as ownership stakes in real businesses. This perspective helps you focus on the company's long-term potential rather than short-term market fluctuations. Second, never invest in something you don't understand. Risk comes from not knowing what you're doing, Buffett warns. His circle of competence principle has protected him from countless losses. During the dot-com bubble, he avoided tech stocks because he couldn't predict their future. Yet years later, he invested heavily in Apple because he understood its consumer appeal and brand power. Third, patience is your greatest ally. The stock market is designed to transfer money from the active to the patient, Buffett observes. He became a billionaire in his 50s, and his wealth grew exponentially afterward through the power of compound interest. As he notes, the stock market is a device for transferring money from the impatient to the patient. Fourth, always maintain a margin of safety. Price is what you pay. Value is what you get, Buffett emphasizes. Before making any investment, he ensures there's a significant cushion between the price he's paying and what he thinks the business is worth. This principle has protected his investments during market downturns and economic crises. Fifth, and perhaps most importantly, continuous learning is crucial. In the business world, the rearview mirror is always clearer than the windshield, Buffett admits. Even after decades of success, he still spends most of his day reading and learning about businesses. He's adapted his strategy over time, from buying mediocre companies at great prices to buying great companies at fair prices. Remember, as Buffett says, someone is sitting in the shade today because someone planted a tree a long time ago. The best time to start your investment journey is now, armed with the wisdom of one of history's greatest investors.